Alright, imagine this. You're sitting in a cozy cafe, sipping your overpriced latte, scrolling through headlines. And boom, another story about a billionaire paying zero in income tax. Meanwhile, your paycheck? Just got hit with FICA, federal, state, maybe even city taxes, plus rents due next week. And you think, how is that even legal? How do the richest people on earth, people with private jets, yachts, and stock portfolios bigger than most countries' GDP, pay less in taxes than a nurse, a teacher, or a small business owner? The truth? It's not just about loopholes. It's a system. A playbook. A strategy refined over decades. Let's break it down. Part 1. The illusion of a fair system. On paper, the US has a progressive tax system. The more you earn, the more you're taxed. Sounds fair, right? But here's the catch: not all income is treated the same. If you earn a salary, taxed at ordinary income rates, up to 37%. If you earn from investments, that's capital gains, taxed at 0% to 20%. And here's where the game begins. Because wealthy individuals don't just earn salaries. In fact, many don't take one at all. They earn returns, gains, dividends, passive income. That's taxless, sometimes not at all. And if you never sell your assets? You don't trigger a taxable event. It's the ultimate cheat code. Part 2. The real strategy. Buy, borrow, die. This three-word formula is at the heart of modern billionaire tax strategy. Buy appreciating assets, stocks, real estate, art, companies. Borrow against those assets instead of selling them. Die, and let your heirs inherit tax-free due to something called the step-up in basis. Let's say you bought $5 million worth of Amazon stock. It's now worth $50 million. Instead of selling and paying taxes, you take out a loan using the stock as collateral. You live tax-free off that borrowed money. Then, when you die, your heirs inherit the stock at its new value, and all those gains vanish from the IRS's radar. You never pay. They never pay. This isn't a glitch. It's policy. Part 3. Real estate, the ultimate tax shelter. Real estate might be the single most tax-advantaged asset class in America. Why? Because of depreciation. You can own a building that's rising in value but still claim that it's losing value every year on your taxes. That's depreciation, a paper loss that reduces your taxable income. Now multiply that across dozens or hundreds of properties. Add in 1031 exchanges, which let you sell one property and buy another without paying taxes on the profit, and you can grow your empire tax-deferred indefinitely. That's how real estate moguls build generational wealth and still qualify for refunds. Part 4. The business of avoiding taxes. If you run a business, the tax code is practically a buffet. You can write off cars, travel, meals, home office space, health insurance, retirement contributions, even private jets, as long as there's a business purpose. Large corporations exploit this at scale. Amazon made billions in profit and paid nothing in federal income taxes in 2018. How? Credits, deductions, R&D write-offs, accelerated depreciation. Then there are offshore subsidiaries, transfer pricing, and intellectual property shelters in countries like Ireland or Bermuda. For every dollar you make, there's a tax strategy to keep it out of the government's hands. Part 5. The carried interest loophole. Let's talk about one of the most infamous tricks in the book, carried interest. Private equity and hedge fund managers earn a percentage of the profits they generate, but instead of being taxed as regular income, it's taxed as capital gains. That's right, they're doing high-risk, high-reward labor, but taxed like long-term investors. Why? Because they helped write the rules. Despite years of public outcry and political promises to close the loophole, it's still alive. Why? Lobbying, plain and simple. Part 6. Lobbyists and legislation. Who writes the rules? Here's the uncomfortable truth. The tax code isn't broken. It's working exactly as intended, for the people who helped write it. Wealthy individuals and corporations spend hundreds of millions lobbying Congress. They donate to campaigns. They fund think tanks. They write talking points. Every reform gets watered down by the time it passes. The estate tax? Loopholes galore. Corporate taxes? Cut and carved with surgical precision. IRS enforcement? Underfunded for decades, making it harder to audit the rich. When tax policy is driven by those who have the most to gain, inequality isn't an accident, it's an outcome. Part 7, Global Perspectives. Is this just a US problem? Not at all. Across the world, wealthier individuals consistently pay lower effective tax rates than the middle class. Why? Global tax havens, Switzerland, Luxembourg, Cayman Islands. Dual citizenships and passport arbitrage. Shell companies and offshore trusts. Lack of financial transparency in international law. But here's the twist: countries compete to attract wealthy residents. They offer lower taxes, fast-track visas, and soft regulations. We're in a global race to the bottom. Part 8. What it means for everyone else. When the rich don't pay, the public pays more, or gets less. Less for roads, schools, and hospitals. Higher taxes on wages and consumption, sales tax, VAT. Greater pressure on the working class. The result? A cycle of inequality. Those at the bottom work harder just to survive. Those at the top pass on untaxed wealth for generations. And the wealth gap widens. Part 9. Can it be fixed? The short answer? Yes. The long answer? Only if we want it badly enough. Potential solutions include wealth taxes on assets, not just income. Higher capital gains rates or taxing gains annually. Closing loopholes like carried interest and step-up basis. Boosting IRS enforcement to audit high-net-worth individuals. International cooperation on closing offshore shelters. None of this is impossible. But it takes public pressure, political will, and a refusal to accept a rigged game as just the way it is. Final thoughts. Rich people don't just avoid taxes by hiring clever accountants. They avoid taxes because the system is designed to reward wealth, not labor. It's not a glitch. It's a feature. But once you understand how the system works, you start seeing the bigger picture: who benefits, who loses, and what it would take to change it. Because at the end of the day, this isn't just about numbers on a spreadsheet, it's about power, policy, and priorities. And hey, if you found this deep dive into the hidden truths of wealth and taxation eye-opening, make sure to like, subscribe, and share it with someone who's ever wondered why the game feels rigged. We've got more long-form explorations coming, unpacking the systems that shape our lives, the myths we live by, and the truths we tend to overlook. Stay curious. Stay kind. And I'll see you in the next one.